make one really good deal a year.
That's John Schaub, who's been investing in real estate for over 50 years and also wrote the classic book, Building Wealth One House at a Time. John also thrived in the early 1980s when interest rates were over 14%.
Couldn't go down and borrow money at the bank at 14% if you paid a retail price.
In this episode, you'll learn how to buy profitable rentals in today's market.
I have never gone to the bank, ever, never once have I gone to the bank to borrow money to buy a house.
Why motivated sellers make the best deals.
I look for people who have, for some reason, they need to sell right away, and I go in and solve that problem.
How to bring partners in when you don't have enough money.
You don't need to own the whole house. If you could just buy 1% interest or 10% interest with another investor, you make some money because of that.
And the one thing even more important than the house itself.
The house are more important to me than the house.
And now we're going to dig into all of that and more. As we talk today into 2023, early 2024, mortgage rates are hovering around 8%, especially for investors, maybe a little bit more. And a lot of people I talk to who've only been in the business, either they're brand new or they've been in the business for a few years, are kind of are freaking out a little bit because interest rates are so high. My question for you is: you started investing in the early mid 70s.
Early 70s.
You've been through some ups and downs of interest rates. Does anything you're seeing with mortgage rates, with the economy now, does it remind you of anything you've experienced in the past?
Well, we had a run up in interest rates in the 70s. We had high inflation and interest rates went up. And interest rates are tied to inflation. So if inflation will die down, if they really get it under control, then rates will probably sneak back down. I'd be surprised if they get down below 5 or 6% though. That's kind of a normal rate for savings was 4 to 5%, and then a couple points above that for mortgage rates. And you can make money at 6 or 7%. That's not a big problem. In my book, I tell people, I've always said, don't pay more than 10% interest. And people have been laughing at me for the last couple of years because rates have been so low. But now they're not laughing. And the rule of thumb is if you pay more than 10, you're just not making any money from a day-to-day basis. You might make money in the long run if you're lucky. But my strategy has always been to make money every day that I hold a property, not just when I sell it. So. Keeping the interest rate reasonable is an important part of that.
When you and I last talked, it was early 2023. Interest rates were about 6%. Some things have changed since then. I mean, the Federal Reserve has raised interest rates. The mortgage rates have followed. There's been some pressure on different parts of the market, in particular some of the commercial multifamily markets. Is there anything looking back at 2023 that surprised you, that's worried you? Like, what are your thoughts on kind of where we've been this last year?
I think it's a natural thing. Rates kind of come and go, and markets come and go a little bit, and you have to be patient if you're a buyer and really define what you want to buy. But I expected the end of this at some point. We've had a run going. Actually, before COVID, we had a long run going, and then COVID really accelerated the run. So we've had a lot of price and rent increases. And they've probably gone higher than they need to be right now. I would not be shocked at all if we see some settling back in both rents and prices over the next couple of years, especially if the economy slows down and we have a higher unemployment rate.
When you have this background inflation, this above normal, what's the general real estate strategy that wins with that economic background? Is it the same as we've always done, buy and hold? Is there any other wrinkles we need to throw to this if we continue to have inflation?
Well, hard assets are your protection against inflation. So you don't want to be a lender. You don't have a bunch of cash sitting around if you're convinced there's going to be long-term inflation. But, you've got to have like a 10 or 15 or 20-year outlook and say what's going to happen to prices in my town and rents in my town and costs in my town. And I think that 5% number has been pretty constant for a very long time, averaged out. There's some years where we have no inflation, but there's other years where we probably have 10 or 15% inflation. So I just book on 5% over 20 years.
And so that 5% is looking at the properties in good locations and good towns. If we can buy a property that grows at 5%, then we have a chance. And then we also add leverage to the equation. That's a basic model for how you can make money as a real estate investor, even if there's inflation. Am I understanding that right?
Yeah, and 5% is mostly inflation. I mean, it's the dollar dropping in value. You can go way back to the 30s, 40s, 50s and see how that dollar has dropped in value over that time. So house prices go up, but it's because the dollar is going down in value, and there's demand and supply. Of course, if your town is growing, if people are moving to your town, then they're going to go up. The house prices will go up more than inflation. people are leaving your town, probably not as much as inflation.
So that's kind of like real estate 101, buying a good location, buy a property that you can hold for a long time to kind of outlast the storms, and then just keep it.
Well, and finance it in a way that makes sense to you. Get the best deal you can with financing. You should argue over every quarter point of interest and drive your costs down as much as you can.
So I want to dig into financing because one of the questions I'm getting a lot, like when I make a YouTube video and I talk about you can still buy properties in 2023, I get a lot of comments that say this is impossible. Everything's changed. The market's different. And one of the problems that I get feedback on is they tell me this. They say, if you have an interest rate that's 8% and you have a property that if you owned it free and clear produces 4% or 5% or 6%, basically the cost of money is higher than the income that the property produces. So you have a negative leverage situation. What I try to tell people is that's not new. Like that's been going on for a long time. But going back to your experience, like how is that? How do we benefit from those long-term trends that we just talked about when the cost of financing is often more than what the property will produce in income?
There's two factors here. It's not just the cost of financing; it's the availability of financing. When the banks shut down, and I feel like that. Defaults we're going to see in the commercial markets and the office building markets and the apartment markets, and those buildings are dropping like flies right now. And the banks are going to end up with a lot of those buildings and take tremendous losses. I mean, they're going to take $100 million losses on those buildings. And enough of that, if enough of that happens, then they're going to tighten up on all their lending because the feds are talking about raising capital requirements for banks. Well, if all that happens the same day, that's going to be the perfect storm. They ended up with a bunch of foreclosures and they have to raise capital. They're going to stop lending money. And so when the credit market gets really tight, that's when you make your best deals. And I go back and look at what I bought. I bought in 1981, I bought 16 properties. Interest rates were 14%. You're right. You couldn't go down and borrow money at the bank at 14% and make those properties work if you paid a retail price. But the prices came down. And it wasn't like prices across the board came down, but the prices of the properties that I bought came down because people that owned them couldn't make the payments. And they were mostly builders and there were bankers that wanted to get rid of them. So there are swings in prices too. Your logic is right. At 8% interest, if you paid a retail price for the house and went down and borrowed 100% of the purchase price at 8%, it wouldn't work. But if you buy that house for 20% below the market and put something down, it does work. So it's a trade-off between how you want to make your money. And if you're just focused on making money with cash flow and you pay retail price for everything, and the hedge funds are doing this, they're still paying more than retail. I mean, Amazon and all these guys pay more than retail price for some of these properties. They made mistakes. It's just not a smart strategy. So, my strategy is always buying one house a year. You make one really good deal a year. Make sure the interest rate is right. Make sure the price is right. Make sure the location is right. Be a real picky buyer, and then you won't get in trouble.
We have a long-term strategy. We buy in a good location. We really pay close attention to that. We buy a good property that attracts good tenants, and then we got to be really picky on the financing. We can't just go. We've had so many people, John, I think, who've gotten used to going down to the bank, buying retail price, putting a 20% down payment, getting a 3% loan, and it worked. That was unusual that you could do that. That's not normal.
That's right. They're out of business now.
Yeah.
They have to learn a new trick. You've heard me say this, and I've said it 1,000 times. I have never gone to the bank never once have I gone to the bank to borrow money to buy a house. There's no reason to do that. There's so many other ways to do it. And the banks, they always charge retail. They always charge retail closing costs. They never, if you buy something below the market, I had a guy walk in my office here who bought something that was worth $200 for $100. Well, the bank would not make him a loan based on $200. They make him a loan based on $100, and he didn't have the cash to buy it. So I loaned him the money to buy it. And so when you find deals like that where you can buy something below the market, first of all, probably don't have time to go to the bank, because if you don't say yes and close right away, somebody else will buy it. A $200,000 house selling for $100, it's not on the market very long. and when you find those deals and the sellers are so desperate to get rid of them, they're just giving them away, you have to be able to move fast. So you can't go to the bank and borrow money and do that. You have to learn other ways to do it. And that's why you and I have both been teaching people how to do it without going to the bank.
I want to ask you a question. If you were having to start over, brand new, you're in 2024, given what we see right here, and let's say you're somebody who makes a decent salary, 90, 100,000 bucks a year. You got 50,000 bucks saved, but you're brand new. Like you got to go buy your first property. How would you approach it if you were in that person's shoes today?
First thing I do is read my book.
Good call. Yes.
Yeah, it may look simple, but there's a lot to this business, and the more you know, the better you're going to be at it, and the more money you're going to make. So, people that go out and put $50,000 down and buy a house in today's market are probably going to lose the $50,000. There's a really good chance the prices could drop by $50,000, and they get mad and they just walk away from it and lose their money. So, first of all, you shouldn't ever put that much money down when you buy a house, because the more money you have invested, the more money you can lose. So leverage is your friend, but you have to learn how to use leverage safely, so you don't hurt the seller and so you don't get hurt. There's something to learn here before you do it. But there's opportunities. I wouldn't be in a hurry. I'm sitting on more than 50, and I've been accumulating cash for the last couple of years because I've been anticipating a recession. Now we may not have one. If we don't have one, I'll spend the money on something else. But I think we will. I think at some point in time that the economy will have a couple bad days, and especially the lenders will have some bad days. And my favorite deal is buying from lenders, and not foreclosures, but I buy their mortgages at discounts, and then I renegotiate those mortgages with people who own the property. So that's the deal that I'll make, and I made many of them last time. We'll make many more of them this coming time. And I also lend money to people who find good deals. Like the guy who walked into my office and bought something really, really cheap. That's a safe loan for me to make. But I'm not going to loan the guy money who's putting 50 grand down and pay retail. That's a dangerous loan. So his only option is go to the bank or to learn something about the business.
I want to go through some of the strategies. Speaking of this person who has 50 grand and they're a newish investor, they're in a high price market probably. I want to go through a few different strategies that you talk about in the book for how they might be able to get in and how you actually got in early, and I did too, when you were in that exact situation. And
hold on right there. I was never in that exact situation where I had 50,000.
You had 50 grand? Okay.
I had $50 cash, so you put a couple of zeros on there.
I had 100. That's about all I had as well. So, well, let's just say we were both new. We didn't have a lot of money, and we were green. We didn't know how to get into this deal. All right.
They were I was there.
So what one of the strategies you talk about is going out and talking to sellers who might be able to finance it to you instead of going to the bank. So you mentioned you never bought a property at the bank. Can you unpack that idea that if somebody's going to buy a house, how do you work with the seller? What do you talk about? Where do you go with that?
Well, before I even get there, I focus on where I want to buy and what house I want to buy. So you really want to kind of draw a picture of what you want to own, and ask yourself this question: do I want to own it for 10 years? Not just thinking you're going to flip it and make a quick profit in 30 days, but am I willing to own this property for a while? And so if you dig a little deeper there, the question is, who are you going to rent it to? How much rent they will pay? Will they take good care of your property? So you have to be in a position to know all that before you make an offer on something. But then you're right. I look for people who have, and some of them, I'd say half the properties I buy are through real estate brokers who bring me deals who say, here's a seller, we can't get rid of this house. They owe more than what it's worth, or their payments are bad, or they're in a hurry. There's some reason they need to sell right away. And they can't, and we can't sell it for them. You can have it. Don't even pay us commission. Just solve their problem. And I go in and solve that problem for them. And if it's a loan, I take subject to loans sometimes. Now, that's a relatively high risk thing to do if you don't know what you're doing. But that means you're taking over their existing loan. You're not going to the bank to borrow money. You're just taking over the loan that's already on that property, and you're agreeing to pay it. And if you don't pay it, it's going to cause the sellers a lot of problems. So you want to make sure that you can pay it. So even if that house rents for $300 a month less than the cost to own it, you can buy that house with absolutely no money down because the people are walking away from it, and you have to put it $300 a month into it for a couple of years. That still can be an excellent deal if you're buying something $20,000 or $30,000 below the market. So you look for opportunities where people need to sell in a hurry. They don't have any other options, and you make them an offer. And you come up with an offer that most people wouldn't come up with, like to buy their house and pay them for their equity a couple of years down the road or 5 or 10 years down the road. I bought a number of houses from builders by giving them a 10-year note with no payments and no interest. But I paid them down the road, 10 years for some of their equity, so they got some of their money back. And that allowed me to take over the loans on those houses and buy them without any cash in to start with. But then I had to put some cash in on a monthly basis to carry those houses for a year or two. But it's a nominal amount compared to a down payment. You're talking $50,000 down. If you lose $300 a month, how long does it take to get $50,000 in that house? And the answer is you never will, because you'll raise the rents over a couple of years, and you won't even be losing $300 a month. So it's a matter of using leverage wisely and looking. But again, don't buy stuff that you don't want to own for a while. It's real easy to buy junk because people buy and finance junk at high interest rates. And they want to get rid of it, but you don't want to buy it. You want to buy something that you know how to manage, and you know what it's going to rent for, so you know what the cash flow is going to be after you buy it.
That assumption that you have to start with a good property and a good location. I made this mistake early on. I listened to your stuff and I listened to other people's stuff about getting creative and doing these financing, and then I went and did that with bad properties, and I got stuck with good financing on a bad property, and it was not fun. It was a bad situation that it took me a long time to get out of. So number one is a good location, good property. But once you see that, you go look for, you said, people in a hurry, people who have some kind of
people have a problem
situation.
And talk to brokers. Don't be afraid of talking to brokers. Brokers will bring you deals. And, the brokerage business goes through big swings. Sometimes, for the last several years, they haven't needed buyers. They had more buyers than they had sellers. They needed listings. But this is going to turn. The tide always turns. At some point, they're going to have a lot of listings they can't sell, and there won't be many buyers. That's when they need you, and that's when you need to talk to them and tell them exactly what you want. To be specific. They'll bring you stuff you don't want to look at, but that's okay. You can make that decision really quickly. And again, my plan is not to buy a whole bunch. Now, I told you I bought a lot of them in 1 year, but that was after I've been buying for 10 years, and I already had a lot of properties, so I knew what I was doing. If you're just starting, you don't want to go out and buy 5 or 10 properties next year. That would be a terrific mistake. Buy one, and then learn from it. Study your deal, see what you did right and wrong. Get a good tenant in there, and once you get all set up, go look for the next one.
So the deal you just explained, I want to go back and put some real numbers on that just so people can kind of slow down and think about this, because you made a really important point. If you go out and find a property in your neighborhood that you like, let's say it's a $400,000 retail property, but the broker brings you a deal, the seller's in a hurry, they're about to be behind on their payments. I'm going to throw a number out there. Let's say their mortgage payment is $2,300 a month, something like that. Well, you look at this property, you like the property, they owe $200,000 or they owe $300,000 on that property that's worth $400,000. And I'm just going to ask, so let's say you buy that property for $350,000 and you take over payments on their $300,000 mortgage. And you mentioned that you would pay them later. So listen, they had $50,000 in equity, $350,000 minus $300,000. So that situation, are they carrying that back as a seller financing?
I'd give them a note for $50,000 with no payments for at least for a while, because I know this house isn't going to make me much money. I may be able to rent it for more than a mortgage payment, but you also have maintenance. And maintenance is 20% of your gross income. So if you don't know that, write that down. You're gonna spend money on roofs and air conditioners and plumbing and all painting and windows. All these things wear out. And if you don't have that built into your program, and a lot of folks who bought the last few years don't have that built into the program. They're buying and I'm talking about hedge funds and guys with lots of money, they're buying big apartment buildings and they're figuring out the maintenance is just eating them up, and it will eat them up. So you have to have money for maintenance. But if it costs you a couple $100 a month to buy that house, and you're buying at $50,000 below the market, and you're simply taking over somebody's loan and giving them a note for $50,000 with no payments for a few years, you've made a really good deal. If you bought in a house that you can rent for enough to cover those payments. So I'd make that deal today. In fact, I have made that deal. I made a deal not long ago that was very similar to that.
I think the biggest opportunity right now is that type of thing, whether it's a $400,000 house, $600,000 house. There are properties out there with people who have a lot of equity, but they're going to get into situations where they can't make their payments. They're in a hurry, and taking over payments or doing some sort of agreement with it where they wait on their equity, it might be the only way you can make a high priced property still cash flow. And that one little, I hope people think about that, because the idea of a seller taking back a single payment, no interest, second mortgage is something that hasn't happened a lot over the last few years, but I know I've done that in the past. I know you've done a lot of that, and that could be a really important strategy for a lot of people.
And it's interesting you call that $400,000 a high-priced house, because I bought a whole bunch of them for $40,000 and $50,000. It's the same house. I bought a house for $30,000 a long time ago. I haven't done anything to that house, basically. I've had a tenant in there for 35 years, almost 40 years now. And I told that tenant, if you don't call me, I'll leave you alone. They never call. They fix everything. And because they like living in this house. But literally, the house looks just like it did almost 50 years ago. But I paid 30-something for it. It's worth $1.25 million today. So, I mean, and that's without fixing the house up. So I didn't improve the house. It's just the lot has gone up that much. So one thing we haven't talked about yet, but the lots are more important to me than the house. And when I try to buy properties today and for the last many years, I focus on lot values because I know it's the lot that's going up in value. The house is going to get bulldozed at some point, especially when it gets to be 50 years old.
What do you look for in a good lot? What are the characteristics that make a lot more valuable than another lot?
Location.
Yeah.
Location.
That's it.
It's just as well, and part of it's elevation. I mean, it depends on where you live. If it's on the side of a cliff, it's a little different. But it really is. You need to know your town. You need to know which neighborhoods in your town are improving. It's pretty easy to spot them because it's the neighborhoods where people are improving houses. They're tearing down old houses and building new houses. They're fixing up houses. If you buy in those neighborhoods, your lot values will continue to go up probably.
When I reread your book this week, you said something that I'd never seen before, which is interesting because I've read it 4 or 5 times. One of the comments you made is buy in neighborhoods that have stability. And you made a point that if a neighborhood's brand new, you got a lot of people, say a builder's building a neighborhood. Everybody is just getting a FHA, money down loan. That is much different than a neighborhood where everybody owns their house free and clear. And if you're an investor in that neighborhood, even if the whole market goes up and down, those people own their house free and clear. They don't have to sell. It's not like that neighborhood is going to go up and down. So I just thought that was an interesting, if you could find neighborhoods where you own them around a bunch of people who own their properties free and clear, that's sort of a buffer around your value, your property.
Yeah, and there's those neighborhoods in every town, unless the town's brand new. But if you live in a town that's been there for 100 years, there's a lot of people that have lived in some of those houses for 30 or 40 years, and those houses are paid for. And they typically are not modern houses. I mean, they're houses that were built 50 years ago. And most of the houses I bought, and a lot of them were brand new when I bought them, are now 30 or 40 years old. So they're not brand new anymore. The fun thing is that the tenants don't really care. Some of those tenants have been in those houses since they were brand new. They've lived there ever since the house was new. And it may need to be painted. It probably needs carpet. But it's their dirt. And they made the marks on the walls. Their kids drew on the walls, and their dogs adjusted the carpet. So, they're not crazy about it. But, if those folks move out, then I've got to spend money rehabbing that house. And I just wrote a newsletter on that, but it makes a lot of sense to rehab those houses because you can spend sometimes $20,000 or $30,000 on an older house and dress it up, and the rents will bump, maybe $500 or $1,000 a month. And so if you can spend $30,000 and get $1,000 a month return on it, that's pretty good return.
So we've talked about the current market, interest rates, different strategies to buy. I want to kind of go back to the kind of long-term strategy of buying and owning properties. And one thing that I read 2 different places in your book again, where one of your strategies that I really like is to buy a property, hold it until it doubles in value. So we're basically at least doubles in value. So you have a strategy to hold on and let appreciation of the rents and of the values do its thing. So that's one part of it. The other part, the recommendation you make is when you're evaluating a property and you're analyzing it, don't ever let appreciation talk you into doing the deal. You say you have to make sure the numbers make sense without appreciation. So I'm just wondering if you can it almost seems contradictory. Like, how do you hold those 2 things and kind of develop a strategy over the long run that takes advantage of both those ideas?
It's sort of like taking the flipping strategy and expanding it out. If people that flip it think they can make a quick $10,000 or $20,000 or $50,000 on a house. Sometimes they do, sometimes they don't.
Yeah.
And actually, the first house I ever bought, the one I was talking about, I thought I'd sell it for a profit, in a year or 2, but I still have it. Well, that one house has made me a whole bunch of money. It's made me more than $1 million in appreciation. Plus, I've been collecting rent on it. It's been free and clear for 25 years. So I made a ton of money on that one house. And if people would just think about the power of just buying one house and getting it paid for that's in a good area, it's going to make them a whole bunch of money. Much more money than you're going to make even buying Warren Buffett stock. I mean, I'll put my houses against Warren Buffett stuff any day, and they made me more money. Now, there is a little work involved. I mean, you have to be able to manage these properties. So learn how to manage, be smart enough to put a good tenant in there and take care of them and take care of the house. But if you'll do that, the difference between cash flow today and capital gains down the road is significant. It's nice to have some cash flow today, but what I've learned is when I have cash flow today, I spend it. I'll go out and buy a new boat or a new plane or go take a trip. The rents that come in get used, and that's okay. That's what they're there for. But what's making me wealthy and will make you wealthy is to hold on to something until it at least doubles in value. And that's going to be a factor of inflation. Plus, hopefully you bought something below the market to start with. So that gives you a head start. And then, if you buy in the right neighborhood, if the average neighborhood in your town appreciates 5%, there's some that are only going up 1%. There's others that are going up 7 or 8%. So if you can be smart enough and clever enough and work hard enough to find one in that 7 or 8% neighborhood, you'll make more money than the average person. So you want to do better than average.
All right, so sticking with this growth theme, I talk to a lot of people who are in high-price markets. They might be in, California, and they might be in New York City. There's lots of places around the country, particularly on the East and West Coast. You said that it's sort of a strategic mistake if you live in a place that is going up in value a lot to go buy somewhere where it's not going up. So for those people who live in those towns, how do they can't seem to get their head around, and it's understandable. How do I buy a property here when it's $500,000, $600,000, and I don't think I can do that? Like, do you have any tips on how they can take advantage of the fact that they live in a place that's growing a lot?
All I can tell you is what I've learned by doing things. I have been traveling to California on a regular basis since the early 70s. And the reason I do that is I think their market, in some ways, influences the Florida market. We're both kind of high growth, southern type, not southern, but south. The weather's good. And when I was first going to California and teaching classes out there in the 70s, you could buy a nice house for $30,000 or $40,000. That same house today sells for $1.2 million. Same house, and it hadn't changed. A little 3-bedroom, 2-bath house with a double-car garage and a kind of nice neighborhood, but not on the water. It has no view. It's just a house. So my happiest students are the ones that lived in California and bought a bunch of houses, and they still have them, because these guys have 30 and 40 and $50 million worth of houses now, and they just bought them one at a time. They did nothing fancy, but they've accumulated a lot of wealth because of that. If they've gone to I have another good friend who lives in California, lives in Sacramento, and a real good friend of mine. He went to Iowa. He went to Iowa, and he bought 30 houses in a little town because they had more cash flow. 25 years later, he sold them for the same price he paid for them. 25 years later. The houses he bought in California held for 25 years went up and doubled in value 2 or 3 times. So you have to think through this long term. The real disadvantage of going out of town is you don't have good information. I've owned property in 10 states, and I've owned property in many towns in 10 states. So I've owned property all over the country. And I've owned those properties with partners typically. I'd have somebody in that town. If I bought a house in Clemson, I call you and say, will you manage this? I'll give you half the profits. And you probably say, sure, I got no money invested in it. Half the profits is a good deal for me. And that's the deal I've always made with my investors, that I would take half the profits, but I'd do all the work. So I did that with all these. Out of, I won't tell you how many properties, but out of most of those properties, I didn't make any money at all. And the reason I didn't make any money at all is because I wasn't managing them, so there was an inefficiency in management. But I never had good information. We sold houses with some very smart partners on the other side. We sold them for less than what they were worth because it was easy. Somebody came along and make us an offer for $100,000 for a house we paid $50,000 for, and they say sure. And that house might have been worth $120,000, or I know some of those houses are worth a lot more today. You won't make as much money doing that as you will investing in your town. And sure, California is expensive. It's always been expensive. It'll never get cheaper, and that's because people keep moving there. I had lunch yesterday with a good friend of mine from New York who moved down here a number of years ago. He says, interestingly enough, your prices here in town now are equal to New York City prices. They've gone up that much. So things are equaling out because part of it's COVID, part of it's people can work from home anywhere now. So the nice places in the world have gone up in value dramatically because of that, and I think it'll continue to happen. So you just have to, if you can't buy a whole house, and when you and I started, we didn't have money to pay cash for a house. I didn't have enough money to go down to get a bank and get a loan. And that's why I had to come up with a different way to do things. But I would end up with a piece of the house. I would go out and find a house that we could buy. I'd have an investor put up the money. I'd do all the work. I wouldn't have any money invested, okay? And I get part of the profit as it went up. And we did this with condos, and we did this with houses. And over time, if you make these deals long enough, 10 or 20 years, over time, they do go up because the dollar goes down in value. So you wake up one day and what you paid $500,000 for in California 10 years ago is now worth $1 million. And so you're giving up that $500,000 profit if you went out and bought something in Oklahoma or Texas or Idaho or someplace else. All these things will probably go up some, but they won't go up as much as they will in the hot markets. So, but it's just a matter of, you have to look around and say, okay, are all these people in my neighborhood smarter than me because they bought a house and I didn't, and they aren't. You just have to learn how to do it. And if you learn how to do it, you can make a lot of money in those hot markets.
So the point I'm hearing is if you believe and if you study and it looks like your market 10, 20 years from now is going to be a lot better than it is today, the only question is, back to our prior conversation, how do I figure out a way to get into the market today?
How do you get your toehold in this market? And even if you just buy, and we can go through a lot of examples here, but if you just buy part interest in a house, you don't need to own the whole house. If you could just buy 1% interest or 10% interest or 20% interest in the house with another investor, now not with a homeowner, but with another investor, you make some money because of that. And so learn how to do that. Learn how to own a piece of the house, not the whole house.
What does it mean to own 20% of a house? Can you give maybe an example of how that might work?
Let's say let's use some simple round numbers. Let's say it's a $300,000 house. It's probably a little higher or lower than most markets, but it's a house you can visualize that you find that you can buy for $250,000, but you don't have the money. So you find an investor who will buy that house, and maybe the investor goes out and gets a loan, or maybe there's an existing loan they can assume or take subject to, where they don't have to pay the full $250,000 for it. So maybe the investor puts up $50,000 and buys this house with a $200,000 loan on it. And you can see that with a $200,000 loan, this $300,000 house will make money. We'll have some cash flow. So you say to the investor, you do that. You buy the house. You put up the money. You will own the house. I will do all the work. I will manage it for a percentage interest. And what I would do with my investors is I would actually have them go down to the bank if there was a bank loan involved and get a new bank loan. So here's a $300,000 house that we bought for $250,000. They go down to the bank and borrow $200,000. Okay, so now they have $50,000 cash invested in this house plus some closing costs, but just keep it simple, $50,000. I would buy half interest in that house right after they closed by giving them a note for half of their cash investment. So if they have $50,000 cash invested, I will give them a note for $25,000, no payments, no interest until we sold the house, and I would do all the work. They would never have to see a tenant, and when we sold the house, there'd be no commissions to me. If we paid another realtor commission, that'd be okay. But we had split the profits, and our goal was to hold that house till at least double. So we're waiting for that $300,000 house to be worth $600,000 before we sell it. Now, when it gets to be worth $600,000, we have a $300,000 profit to split up. I'd get $150,000 of it. They get $150,000 of it. What they've given up is the interest they could have earned on that $25,000 because I gave them a note with no payments and no interest for 10 years or whatever it was. So if you think how much interest they could have earned on $25,000, well, at 10%, that would be $2,500 a year. If you compare that to the profit they're making and to the fact that they don't have to pay any management fees and they don't ever have to talk to a tenant, it's a totally passive investment to them. It's a terrific deal for them, a really good deal for them. And of course, it's a good deal for me because I make $150,000 with no money invested just because I did the work, put it together, and do all the work during the term. And I did that many times.
I remember the first time I heard that, and it was probably my first year in business. I heard you explain that, and it was like a light bulb for me. And I at the time, and I still today think, that deal is good for both sides.
It's a real good deal for both sides, yeah.
It made a ton of sense to me because very rarely, I think about today, a lot of people are into syndications, for example, where you go out and you invest your money with this big group of $50 million worth of property. And I don't like those deals. I get nervous because I see the big stack of papers that an attorney drew up and I don't understand any of them. But this deal, I understand it. I would take either side of that deal. And that's a really good practice in business, is to say, is this a deal I would do either side? And if so, let's do it.
True. Yeah, and I do, and I've done both sides of that deal. I've taken both sides many times, and happy to do it today. If somebody walks in my office and they have a deal, need the money, I'll put it up for half the profit. That's a fair deal.
Love it.
That's a fair deal.
Very, very good. Well, thank you for all you do with your book, with your message, for being here. I really appreciate it. It's always helpful for me. I want you to let you tell people where they can hang out with you, where they can get your book, and your website as well.
Well, the book is available on Amazon. We don't stock them here at the office, so just go to Amazon. It's on sale every day. My website is johnschaub.com, so you can go to that and see other things I've done. I've recorded courses over the years. I don't teach much. I'll be teaching a class with my friend Peter Fortunato in Tampa, April 13th and 14th this year, 2024.
Well, I'll put links to all that in the podcast description and the YouTube description. John, thank you again for your time. It's good talking to you.
My pleasure.
Hey, if you like this interview with John Schaub, I think you'll like my next video where I summarize and give you the most profitable ideas from his great book, Building Wealth One House at a Time. In the video, I share the actual strategy for how to get rich one house at a time. I also show you why owning properties free and clear of debt is a good goal in real estate. And then I share John's advice on how to pick the best rental properties, both the house and the location, so you can make the most money over time. There'll be a link in the podcast description or the YouTube description below, or if you're watching on YouTube, you can click on the video above me.